In this video, we introduce the trial balance. In this world of computerized accounting, we don't necessarily see a trial balance. That is because if we have entered all the relevant data entry and journal entries, the computer will automatically post the entries to the appropriate T accounts or ledgers. The computer calculates the new ledger balance with each entry. It automatically summarizes the balances and creates a trial balance. The trial balance is proof that debit-credit equality has been maintained in the system. It is a listing of all balance sheet and income statement accounts with their respective balances. As such, even though maintaining a set of books on a computer using the appropriate accounting software does not require us to develop a trial balance, we feel it is important to have created one manually. Seeing is believing. Here we introduce the trial balance. It occupies 2 slides because all the data cannot fit on one slide. We begin with existing balances for asset accounts and a few of the liability accounts. Here we see postings to the accounts from various journal entries. Here we show the trial balance data in 2 slides because its length cannot fit on one PowerPoint slide. In the days of manual bookkeeping, a trial balance showed assets, liabilities, capital, revenue, and expense. It proved that the balances in the T accounts or ledgers maintained debit-credit equality. In today's world of computerized accounting, the trial balance can be had with the push of a button. The trial balance is maintained internally by the computer. We show it here because it is part of the information flow involved in producing financial statements, where, if done correctly, assets equal liabilities and capital. Journal entry number 11 is the first of what we call adjusting entries. Here we debit cost of sales and expense, $4,500, and credit merchandise inventory, $4,500, an asset. This reflects the cost of the merchandise sold during the period. Here with journal entry 12, we record depreciation expense for our company, $450. We credit the valuation or contra account, accumulated depreciation for $450, and debit depreciation expense. Credit accumulated depreciation, $450. Here in journal entry 13, we have what is known as a compound journal entry. This journal entry impacts 3 accounts. Observe that debit-credit equality is still maintained. Here we are paying down a note payable for $300, while at the same time we are paying interest expense for $100 and crediting cash for $400. If you are a homeowner or you have an auto loan, you know that part of your payment goes toward the loan balance and part is interest expense. This entry is what it looks like in a set of books. Here in journal entry 14, we have another adjusting entry. There is no trigger for this entry. It does not involve cash or an invoice for expense. As accountants, we know that the matching principle requires us to write a journal entry, charging to expense, specifically bad debt expense for $150, and a credit to allowance for doubtful accounts for $150. The allowance for doubtful accounts is a valuation or contra asset account. In journal entry 15, we are paying income taxes, a payment to a governmental body, debit income taxes, $500, an expense, and credit cash, $500. Here we summarize journal entries 11 to journal entry 15. Notice debit-credit equality is maintained. These 5 are all adjusting entries. As accountants, we have to be proactive in recording these entries. Journal entry 11, cost of sales, has to be recorded. It recognizes the cost of merchandise sold and records the decline of the inventory. This is called the periodic method of inventory management. At the end of a period, month, quarter, or year, a physical count and valuation of the remaining inventory is deducted from goods available for sale to arrive at cost of sales. Another method, the perpetual method, uses the computer to debit cost of sales and credit a specific item in the inventory. Physical counts of the inventory are taken periodically to see if the computerized inventory equals what is found on hand. Journal entry 12. Depreciation expense has to be calculated and recorded, $450. Accumulated depreciation is credited for a like amount. The account is a valuation or contra account, a reduction of the value of equipment. Journal entry 13, notes payable, needs to reflect the payment on the balance of a note, 300, and the attendant interest expense, 100, and cash credit of 400. This journal entry is known as a compound entry. It has two debits, a debit to notes payable for 300, lowering that account, a debit to interest expense for 100, increasing interest expense, and a cash payment of 400. Journal entry 14, 150, bad debt expense needs to be calculated and recorded. Credit allowance for doubtful accounts, a valuation or contra account. Journal entry 15 is a payment of taxes for 500, increasing expense and decreasing cash, an asset account, 500. If you remember early on in this program, we suggested memorizing dealer, D-E-A-L-E-R, dividends, expenses, assets, liabilities, equity, and revenue. The first three have normal debit balances. The last three, liabilities, equity, and revenue, have normal credit balances. The dividend of 500 here is a distribution to stockholders, or owners or partners in an unincorporated business. The dividend lowers the equity account, and the cash credit lowers cash. 500. Assets down. Equity down. Journal entry 17 is another adjusting entry. No cash is involved, so a cash basis set of books would not record this entry. Here we are debiting marketing expense for 1,000 because we incurred the expense, and because we have not yet paid it, we credit accrued marketing expense, a liability. In the subsequent period, we pay off accrued marketing expense with a debit to that account and a credit to cash. Liability down, cash down. No recognition of the expense in the subsequent period. Here in Journal 18, we pay for an expense that has not yet been incurred. It could be insurance expense and paying for 6 months ahead. Debit, an asset account, prepaid expense for 1,200. Credit cash, 1,200. Assets up, assets down. In a subsequent period when the expense is incurred, we debit expense and credit prepaid expense. Here we summarize journal entries 16 to journal entry 18. Notice debit-credit equality is maintained. Here we have the T accounts, or ledger, for all balance sheet and earnings statement accounts. Journal entry 11, debit cost of goods sold, 4,500. Credit merchandise inventory, 4,500. Journal entry number 12, depreciation expense, debit, 450. Credit accumulated depreciation, 450. Journal entry 13, compound journal entry. Debit notes payable, 300. Lowering a liability, debit interest expense, 100. Credit cash, 400. Journal entry 14, record bad debt expense, debit 150. Credit allowance for doubtful accounts, 150. Journal entry number 15, paid income taxes. Debit income tax expense, 500. Credit cash, 500. Journal entry 16, debit income taxes, 500. Credit cash, 500. Journal entry number 17, debit marketing expense, 1,000. Credit accrued expenses, marketing, 1,000. In this entry, no one is going to tell us to record this expense. We have to be aware of it as an unpaid invoice for marketing expense. Since no cash was involved, a cash basis bookkeeper would understate expense here. Journal entry number 18, debit prepaid expense, 1,200. Credit cash, 1,200. Here we are paying for something before we use it. It could be a bill from an attorney before services are rendered. It could be first month's rent before moving in. We prepare the trial balance here as a precursor to preparing the financial statements. It lists all the assets, beginning with cash, then liability and equity accounts, followed by revenue and expense accounts, the income statement. If we have posted everything correctly in the T accounts or ledgers, then debits should equal credits. We prepare the trial balance here so we can see and understand what steps are taken, from journal entries to T accounts to trial balance and then financial statements. The second set has the postings of the adjusting entries. The journal entry numbers are shown so we can determine what gave rise to a posting. Notice all the postings to the cash account. The third set of debits and credits is the adjusted balances. We start with the unadjusted balances. We post the adjusting entries in the second set, and then we add or subtract to give us the ending balance. Let us take the opening cash position, $7,500. In the adjusting entries, we have $2,600 in credits. Credits are a reduction of cash. 400 plus 500 plus 500 plus 1,200 equals 2,600. Accordingly, 7,500 minus 2,600 equals 4,900. The balance you see for cash in the third set of debits and credits. Here we have the second page of the trial balance with some liability accounts, the revenue account, and the expense accounts. Notice debit-credit equality is maintained. Before the adjustments, $26,000. During the adjustments, $8,700. And the final trial balance, $27,300. Notice that we can see the income statement showing revenue of $9,000 and all the expenses starting with cost of sales at $4,500 and the whole list of other expenses, from sales commissions down to income tax. As we have stated, computerized accounting software prepares the trial balance automatically. We can view it any time after any posted data or journal entries to review. Period. Set 1, unadjusted trial balance, debit and credit. Set 2, adjustments, debit and credit. Set 3, adjusted trial balance, debit and credit.